Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We're also streaming to you live on yorbamedia.com and broadcasting to you from the Dallas KFXR 1190 AM Clear Channel studios. All right, my first guest on today's show, new to the show, Randy Kenworthy. He is the managing general partner of Coachman Energy Partners. Randy, welcome to the show.
Thanks, Michael. Glad to be here.
My pleasure. All right, Randy, you've got an energy company, and it's got some uniqueness to it. I was hoping that you could give us a little background about yourself, what's going on with you in this business, and then tell us more about Coachman Energy Partners.
Yeah, absolutely. Yeah, Coachman Energy was founded in 2006, and it was really kind of founded under the principle that you could actively manage energy assets. And when you take a look at the typical kind of portfolio management, if you will, you have a variety of stocks, bonds, that type of thing in a portfolio, and you invest in that portfolio. And then as the market changes and the market shifts and different issues come in and out of favor, you adjust your investments. And, the typical, kind of oil and gas program or oil and gas fund, typically invests in assets. It's more of a buy and hold for a long time strategy. You buy assets, you drill them, and then you hold on to those wells for 20, 30-year kind of time frame. What we do here at Coachman is we look at the different reserve classes as the equivalent of a stock or a bond, if you will. So we have PDP, proved, developed, producing reserves. We have PDNP, proved, developed, not producing reserves, wells that are waiting to be fracked, basically, or waiting for completion that have been drilled that are flowing back. Proved undeveloped reserves, which is any potential well location within, basically 1 mile of existing production. And then your unproven reserves, which are probable and possible reserves. And we've developed a pretty sophisticated strategy using financial analysts and a lot of data and computer models inside of Coachman to track those different reserve classes in all of our programs. And basically what we do then is when we drill a well, we watch that well as it begins to produce and it declines. And effectively, as it reaches about that 15%, annual decline rate, we sell that production off, and then we take those funds generated by the sale of that production and we recycle that capital and we drill more wells with it. And we're able to enhance performance through that strategy.
It sounds as though that you have access to a liquid market where you've created liquidity where there's normally none.
Not effectively. Our programs are private Reg D offerings, and so we don't really have liquidity in those offerings.
Well, I'm talking about the sale of these assets because there are other...
Actually, absolutely. Well, you're selling a well off. You are creating, you're freeing up capital that's a drag on performance.
Right. That sounds good. How long is there an average time span, or is it a percentage of remaining assets in the well that you have a threshold on? Whenever it gets to this point, this is when we start to get out and recoup or sell it for additional profits for our clients.
Well, all wells are different because all wells perform at different rates, but
right.
The models that we've built, track how a well performs, how much revenue and profit's been generated from a well, how much reserves remain, and these tools that we've developed will allow us to kind of pinpoint the optimal time to sell a well and then recycle that capital. It's usually somewhere around 2 years up in North Dakota in the Bakken, which is our primary area of exploration right now. But 2 years is a good kind of round number.
2 years from the time you've run the wire line and you've got the reserves and done all the fracking, you've got the reserves flowing. Is that what I'm hearing?
That's correct. Yeah, two years from when the well starts to produce.
Okay. You mentioned the Bakken. I know that for the last, I guess 4 or 5 years, it's been a really, really hot spot. Why don't we go into that and tell our audience what you've discovered there and the things that you're looking at on undeveloped acreage.
Yeah, the Bakken is a game changer for the United States in terms of energy independence. And we're very blessed in this country now because we have a number of these large shale reserves around the nation. But the Bakken really got rolling kind of 2007, 2008. What's really made that work is long lateral horizontal drilling and multi-stage fracking. When we started drilling up there in 2007, your average well would produce 150,000 barrels or so over the life of the well. And through advances in technology, primarily hydraulic fracturing with man-made materials like a ceramic proppant, where you're fracking these wells now in 25 to 30 stages. In the areas that we're now producing in the Bakken, our average wells, depending on what field we're drilling in, can go from 620,000 barrels all the way up to about 1 million barrels recoverable over the 40-year life of the well. And it's these technologies that have really made these shale resources highly economical, and it's really started to narrow the gap in our country, of what we export or what we use internally versus what we import.
Now, in that note, I've heard pluses and minuses about horizontal drilling, and one of which the minus would be the massive declination rate, but then it levels off and runs for a heck of a long time. Open that up for us.
Yeah, it's really not so much in North Dakota. It's not so much a factor of horizontal drilling, where you get your big decline rates. It has a lot more to do with the reservoir that you're drilling. The Bakken is a very, very deep, very in a lot of areas overpressured reservoir. We'll have 8,000 to 9,000 pounds of pressure down hole and in kind of the central part of the basin. And as you move up dip, or you move up from about 10,700 feet where we're drilling up to, up towards the Canadian border, about 8,000 feet, you're going to go up to about 5,000 pounds of pressure. It's really akin to taking a bottle of champagne, shaking it up, and blowing the cork off. And then when you do that, a lot of a third of the bottle or half of the bottle of champagne flows out of the bottle. That's what these wells are like, and that's why they have such significant decline rates. It's not as much a factor of the drilling as it just is the natural pressure of the reservoir.
Okay. All right. Yeah, I wanted to bring that out and remove some of the thoughts that most people have about horizontal or unconventional drilling. What about the efficiencies most associated with manufacturing?
Well, these resource plays are interesting because you hear the term unconventional resource play, and unconventional just refers to the fact that we don't produce oil out of these plays in a conventional sense. We're not shooting 2D or 3D seismic, and we're not drilling vertical wells. We're not looking for a geologic anomaly underneath the surface of the earth, some sort of trap that's holding oil. The Bakken is covers about 2/3 of the state of North Dakota and the northeastern corner of Montana, and it's all one large big oily rock. And where you get the efficiencies now, what we're starting to see is where we have pad drilling coming into play now. We're really in a development phase, and it's really, as you said, it's a manufacturing process. You move the rig in, and you'll drill anywhere from 4 to 8 wells off of one of these pads. And once those wells are drilled, you slide the rig over. You don't even rig up and rig down anymore. You slide the rig over, or you drill another 4 to 8 wells, and you slide the rig and drill another 4 to 8, and you just keep going. It's a very efficient process, and you really have that kind of learning curve that you have in manufacturing, where you get to a point where you've really nailed things down, and you get just significant efficiencies.
I've also heard that there is significant capital required to go ahead and drill this way, which I would imagine leaves you opportunities for acquisition in the general area. Is that a correct assumption?
Yeah, that is very correct. Pad drilling is going to have a profound effect on the production of these reservoirs around the country. And if you think that up until about a year and a half ago, we were getting AFE'd, authorization for expenditure, and invoice for a well. We were getting invoice for one well at a time, and at that time the average cost of these wells was in the $10 million range. If you own 10% of one of these wells, you had to pay $1 million for your portion of the well. We are a non-operating working interest owner, so we drill with the biggest and the best in the Williston Basin in North Dakota and Montana. We recently received an AFE from one of our operators. It was for 7 wells off the same pad. So instead of having $1 million upfront, capital expense, you now have a $7 million upfront capital expense. And the way they drill these wells now off the pad is they drill them in a serial fashion. So they drill half of the first well, half of the second well, and so on. Then they change the drill string out. They finish the drilling. Then they slide the drilling rig away, and they move in a workover rig in, and they complete them in the same way or frack them in the same fashion. So that process now has extended out our cash flows by about 120 days. Was taking us about 6 months to get our first check off of a new well. It's now taking us around 10. And in addition to that, if you have any existing wells that are currently producing on or near that spacing unit that you're drilling from this pad rig, you have to shut that well in while you're drilling it to pressure up that well so that the fluids from the drilling don't seep through the reservoir or the rock and contaminate the existing well. So you lose the cash flow from that existing well for a 3 to 4 month period of time. So it's very expensive and it's very cash intensive, to participate in these big shale plays.
And therein lies the opportunity. When somebody gets in that hard spot between production and non-production, then you can come in and pick them up and relieve their pressure. I get it.
Yeah.
Randy, let's take a break right now. We're a little bit over our segment and cover the rest of your topics on the other side of this break, okay?
Sounds good.
All right, we'll be right back with Randy Kenworthy, Managing General Partner, Coachman Energy Partners. Special thanks to Monk Media and 1-800-PublicRelations.com for all their PR and media support. Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We're also streaming to you live on yorbamedia.com and broadcasting to you from the Dallas KFXR 1190 AM Clear Channel Studios. All right, on the set with me, Randy Kenworthy, Managing General Partner, Coachman Energy Partners. All right, Randy, welcome back to the segment. Appreciate that.
Thanks.
My pleasure. All right, let's move on to some other topics here. Now, Coachman's asset management philosophy. You brought that out in the first segment, and we touched on it. But can you sum that up for us and then give us an in-depth run-through, if you will, of the different processes in your management philosophy?
Yeah, sure. Our management philosophy is that you take a look at your reserve classes in an oil deal. Again, you have 5 reserve classes. Proved developed producing wells, an existing well that's producing hydrocarbons, a PDMP well, a well that's been drilled that hasn't been fracked or is awaiting completion, a PUD, proved undeveloped reserve. That's basically anything that is yet to be drilled within about 1 mile of existing production. And then you have probable and possible reserves, and we treat those basically as any investor would a stock portfolio. Those would be individual issues in our portfolio. And at any point in time in the portfolio, based on what we're trying to accomplish, we try and balance the mix of those issues or those reserves, in our case, in the portfolio to achieve, annual yields or overall returns for our programs.
Okay, so it's basically acquire, drill, harvest, and recycle.
That's absolutely correct.
Okay, all right. Let's talk about looking forward, the Bakken 2014 outlook. Give me an idea what you're thinking. I mean, how much time do we have to develop that area?
Oh, gosh, Michael, I think we're going to be drilling the Bakken 50 years from now. I think it's got a long way to go. If you listen to guys like Harold Hamm, the CEO of Continental, Harold's estimating 32 billion barrels recoverable, and out of the resource. And what we were thinking when we originally got involved in this thing here over the past few years was 4 Bakken wells and 4 Three Forks wells, which is a zone that we're producing about 100 feet under the Bakken throughout most of the state, per spacing unit. And now a lot of the big guys that are drilling in the basin are predicting that we're going to have upwards of 20 wells per spacing unit. In 2014, I think what we're going to see in the Bakken is we're going to see an acceleration of drilling, no doubt, but we're going to start to see now a real proving of the Three Forks reserves. What we're finding in the Bakken is really a stacked pay opportunity, because the Three Forks, again, which sits about 100 feet underneath the Bakken in a vast area of the state, has 4 independent branches, or 4 independent benches, that can be produced. We've been drilling the first bench now for the past 3-4 years, and it's highly productive. In the areas that we're drilling, it generates probably about 65 to 70%, maybe 80% of what a typical Bakken well will generate. We have a number of Three Forks wells that we've drilled that actually outperform or exceed the production of typical Bakken wells. And now we're starting to drill and produce the second and third benches. So when you look at recoverable estimates in the region, in the Williston Basin, which again encompasses most of North Dakota and a little bit of Montana, those estimates really don't take into account the amount of oil that exists and sits in these 4 Three Forks benches.
Okay, give us an idea. I mean, you said several billion barrels. Is this Bakken going to make America be the lion's share of making America energy independent?
I don't know if the Bakken alone will do it. I think the Bakken is a game changer, and it's a step in the right direction. We have other very large shale basins. You have a couple great ones in Texas, right? You have the Eagle Ford and the Permian, and those are analogous. You've got the Utica and the Marcellus in the Northeast, and so again, we have a lot of these large shale basins in the country, and if you combine them all, it's certainly moving us in the right direction. And in 2013, we produced almost 90% of the energy that we consume inside our own country, and we've narrowed the gap in terms of exporting oil by, coming up on pretty close to 3 million barrels a day now over the past 6 or 7 years. When we started drilling in the Bakken in 2007, it was producing about 175,000 barrels a day throughout the entire state, and the state is now producing well over 1 million barrels a day. That's significant in terms of moving the country towards energy independence.
Yeah, I would agree. I would definitely agree with that. You're running how many wells simultaneously now?
We've got right now about 120 wells that are producing. We have 22 or 23 that are drilling, and we've got AFEs in-house for wells that will be spud or put a bit in the ground here in the next 2 or 3 months for another 26, 27 wells.
Wow, that's quite a handful to keep track of. I know, because each one of those has several moving parts. It can break all the time.
Yeah, it does. It's a challenge. It's data intensive, and you have to be very good at logistics.
In your analysis, obviously you're analyzing the wells and you're trying to find the true net value so that you can make a trade when you're ready to move them out of the portfolio. But there's also has to be an analysis of where you think pricing is going to go for the gas and the oil that comes out of these wells. What are your thoughts there?
Well, in terms of pricing, our analysis this year, we believe we're going to end the year somewhere between $85 and $95 a barrel on the oil side. We believe we're going to be $4.75 to $5.10 on gas. And there certainly is on the gas side. There's a couple things that could change that equation, and that really is liquefaction of gas and starting to export natural gas. If that continues to move forward, we'll start to see gas prices, I think, rise a bit quicker. But oil, I think, unless there's some significant geopolitical event like Russia, in invading other countries, I think oil's probably going to end up somewhere in that range.
Okay, thank you for that. We're about out of time on this segment. I wanted to see if there's anything that goes on with your company that, whether you have videos of what you're doing, you have any presentations that you make in public, or how somebody could follow up with you to carry on the conversation that you brought to the show today.
Yeah, I appreciate that. The best thing for anyone listening, if they want to learn more, is to contact their financial advisor or their registered broker-dealer, and they can help them get in touch with us.
Okay, that sounds great. All right, Randy, thank you so much for taking the time to come on to the show. Sincerely appreciate that.
All right, Michael, thank you so much. Have a good day.
You too. Randy Kenworthy, Managing General Partner, Coachman Energy Partners. That's CoachmanEnergy.com. And special thanks to Monk Media and 1-800-Public Relations for all their PR and media support. 1-800-PublicRelations.com. All right, up next, we've got Jeff Bird, Director of Sales of, I can't pronounce it, so we'll ask him how to pronounce it when he comes back. We'll be right there.